Hi, my name is Kevin Moen, and I'm the president of Root Energy Homes. We're here today to talk about turnkey rental properties and how to invest in cash flow even if you don't have a ton of real estate experience. I'm excited to take your education level up a notch and answer any questions you have in a follow-up. So why are you here? Well, in the next 15 minutes, we'll learn how the banking system is destroying your wealth and what you can do about it, about investment trends and post-2008 market shifts in the new housing economy, and how to earn passive income with turnkey rentals, no banks, and note investing. We do take regulations and the law seriously, so please read through this disclaimer as we are not offering any securities today and we're operating well within the SEC regulations and rules. Alright, so we'll be covering a quick history on banking, traditional investment options, what is a note and why notes, who is Root Energy Homes, and how does it all work. Alright, I'm going to go through this section relatively quickly so we can focus on the cool and more fun stuff that we're all here for. Let's get started. On July 4th, 1776, America becomes independent with the idea of pursuing the promise of life, liberty, and pursuit of happiness. In 1913, Woodrow Wilson put the Federal Reserve Act into place, and then later in 71, Nixon took us off the gold standard, which has led to a debt-based society that we'll talk more about. Our banking system is what's called fractional reserve banking. That essentially means that when a deposit is made into the bank is required to reserve about 10% of that deposit and then goes in loans or does other investing activities with the remaining funds. As the illustration in front of us shows, that with 100 units deposited, just 2 steps later, 171 units have been created. Think of a unit as a dollar. This is the way our banking system currently works. Ever since going off the gold standard, we are a debt-based currency. As you can see in the purple line on the chart in front of us, the debt has grown exponentially since that event happened. This is taking away our power and making the dollar weaker each and every year. Another important point to understand is there is nothing federal about the Federal Reserve, who I'll refer to as the Fed. The Fed loans money to the United States government with interest. They've never been audited. They're owned by private stockholders, which is completely unconstitutional, and they get their money from the mint and resell it to the United States for a profit. As can be found on the congressional record of June 10th in 1932, the Federal Reserve is not a United States institution. They are private credit monopolies which prey upon the people of the United States for the benefits of themselves and their foreign swindlers. That was a comment made in 32, and it still holds true today. We believe strongly in financial responsibility. That all starts with lending. That's why we do our own seller financing and also take houses that aren't in great shape, occupy them, which helps communities. Lending must be carried through in an ethical, informed, and intelligent way. We remove the bank. Now let's talk a bit about traditional investment options. Firstly, you've got bonds, as well as savings, which both are paying next to nothing in their return. We also have stocks, which tend to be relatively high risk, maybe not if you are a daily trader or an expert in that field, but they tend to have a lack of control and the earnings can vary. Then you've got your IRA. That's not really an investment as much as an investment tool, but a very powerful tool and something that we can utilize. Same thing with the 401k. And lastly, I included real estate because it can be seen as a traditional investment and is certainly a good tool to grow your money if you know what you're doing. Now with the stock market, kind of like real estate, it's basically all dependent on supply and demand. Every time that we reach record highs in the stock market, a crash isn't too far to follow. The reason we prefer real estate over stocks is we have control over the assets, and even if there's a crash, you still own your asset and can ride that wave out. What about bonds? Well, bonds can be a relatively safe place to invest your money, but you're not going to grow it very quickly, if at all. This chart in front of us shows the trends of money flow from the bond market. And as you see, the latter part is reflecting that money is being taken out of bonds as investors are placing it in more profitable investments. Now, ever since the '08 crash, with so many investors losing their confidence in the stock and bond market, many more IRAs are being treated as a parking lot for cash. That's not a terrible thing, but it's not growing those investors' funds. We can utilize those funds and help you put any funds in your IRA to work. We'll talk more about that later. What is a note? A note is a mortgage or deed of trust, at least in our business and what we deal with. Whether it's a mortgage or deed of trust depends on what state the property is located in. Along with the mortgage or deed of trust comes a promissory note, which spells out how much, when, and where that funds should be repaid. A simpler way to think about it is any IOU. Even a dollar bill is a note. It is legal tender, which is essentially stating an IOU. So what secures our note? Well, we buy notes at a discount. That means that if a house is worth $100,000 and we're investing $60,000 into the note, we've got $40,000 of what we call protective equity. That's essentially a cushion between the value of the property and the amount of money that we have in the deal. We also have foreclosure as protection in case of default, meaning if someone stops paying or if they're not paying when we buy the note, we have the right to foreclose on the property, although we treat that as a last resort. The borrower pays our licensed servicer, who then deposits those funds in our account. That way, we're not required to be licensed to work well within the law and outsource all of the tricky accounting to our team. So why notes? Well, if you're a real estate investor, you probably rely on REOs or have heard of REOs as a good source for cheap properties. Well, in the last 3 or 4 years, REO inventory has been shrinking. This is not good for investors as their supply is starting to diminish. A better illustration of the difference in inventory is shown on this chart. The lighter, more tan color are non-performing loans. Those are NPLs. Then the more caramel color at the bottom of those charts are REOs. You can see the staggering difference in the amount of properties or notes available. Lastly is short sales, and you can barely even see that color on this chart. So literally towering over the other two options, non-performing loans have the greatest inventory. So where's the inventory? Well, between 2008 and 2013, only 4.5 million properties were sold as a short sale or REO. To put that in comparison, there are over 10 million delinquent mortgages in America today. So as you can see, since the 2008 crash, there has been a significant shift from REOs to notes. That is mainly because the banking institutions realize they are not real estate firms. They are far more profitable by selling thousands of tapes, which is basically a bunch of notes, than they are to foreclose and sell properties one-off or even in batches. This is a whole new era in the housing industry, and we're excited to be on the front lines of the note business, especially as it takes off. To further illustrate the shift in the housing market and the effects of the crash and money shifting from stocks and bonds over to real estate is the chart in front of us that shows us the percentage or the overall dollar amount of purchases in the real estate business. So the bottom line are the years, with 2013 being the most recent on this chart. We got as high as 55% of purchases occurring in all cash. That represents investors from all parts of the world. This has never been seen before and truly exemplifies the new housing era ever since the 2008 crash, which has left so many stock market refugees, as we like to call them. So where's the real opportunity for the average investor? Well, surprisingly enough to us on the West Coast, in the central United States, average property values are $40,000 to $60,000. Even though the houses are a lot cheaper, the rents are still $500 to $850 and more, which is why these properties cash flow so well and why we focus in these parts of the country. It's all about cash flow, and we'll talk more about that later on. So why notes? Well, there's high inventory, low competition, and affordability. Who is Root Energy Homes? Our mission is to create affordable, sustainable American communities by providing efficient, beautiful homes while creating an exceptional customer experience and promoting financial responsibility. We sell income secured by real estate. There are two sides to our business. We sell turnkey rental properties, which is what we're here to talk about, and we also sell performing loans, which you can follow up with us later on if you want to learn more. Again, we sell income secured by real estate. Turnkey rental properties. So our strategy is to buy non-performing loans, which means that the borrower has stopped paying, and then take ownership of the property. We get a large discount because the loans aren't very valuable when the buyers aren't paying. We then take ownership of the property, renovate, and occupy with a renter and professional management. Then we sell to an end investor, who could be you, with seller financing in place. That means we're the bank. There's no credit, no messy applications, or other headaches that come along with normal banking applications. We create financial stability in our local communities for our investors and in communities across America with more sustainable housing. So Kevin, we've been talking about notes. Why real estate? Why turnkey rentals? Well, real estate allows for a high rate of return and ability to control the asset. Market trends are generally predictable, and even in a crash, you keep your asset and oftentimes keep your cash flow. The investment's backed by the actual property itself, and there are tax advantages for landlords. The safety nets are your promissory note, mortgage, hazard insurance in case of natural disasters, and again, investing for cash flow, which is relatively recession-proof. Invest for cash flow. We like to target areas where rent is twice the expense as a mortgage payment. That doesn't occur in areas like Seattle and California. This is the central United States or the Midwest or the southern United States, where rents are literally twice as much as it would cost to buy the house based on the property values. We invest in low-cost living cities and leverage our money to earn more through our passive income. We hire property preservation companies and management to take care of all the dirty work, so our job is truly just to make sure that cash is flowing in each month. Investing for cash flow is nearly recession-proof because even in a recession, people have to live somewhere and they have to rent. So how does this all work? So our investors make a down payment wired directly to escrow and get a securing document where we get the mortgage so that we can take care of our job and have the legal right to proceed as we need to. We then repair the property, find the tenant, and get the lease and property management in place. From start to finish, it looks something like this. It all starts with you, the investor. You then set up a free consultation with Energy Homes. We get to know your goals and get an agreement in place. We then close on a property with your funding and your own security instrument giving you rights to the property. We repair, place a tenant, and sell it officially to you, getting rid of our lien on the property and then having rents deposited directly into your account handled by your property preservation company. No tenants, no toilets, no headaches. Property management handles all that, and you just manage your managers. When your renters pay rent, your property management company will collect that payment. They then take their fee and deposit the remaining funds into your account. You will owe us the mortgage payment because we finance part of the sale to you. So then you pay us directly and keep your own cash flow if you're doing our 20-year program. We also have a 5-year loan program, which is great for retired people or those who don't need cash flow now but want to own the property free and clear as soon as possible. In those deals, there is no cash flow today, but the property is free and clear within 5 years, which really accelerates your income in that time period. You then are collecting all the rents and not making any payments to any debt or any bank. So I know this probably sounds like a lot of work, but most of it is outsourced. There are property preservation companies which collect payments, pay taxes and insurance, make any collection calls, and handle tenants, toilets, and emergencies. Those are your property management companies, and we'll make sure you're set up with a good one as part of our job. Some of our policies to ensure ethical lending practices include one investor, one loan, one property. What that means is we do not pool funds.